Hello, everybody. Welcome to Collective Investments. Let's continue to talk about the most important investment strategy that this channel advertises, which is buy and hold US broad market index. So, in a previous video, we have discussed why we want to pick US stock market. This is because US stock market is the best with the highest historical returns. We also discussed why we want to use a broad market index instead of picking stocks. This is because picking stocks is very hard, and it's a zero-sum game against professional money managers. Similarly, why do we buy and hold instead of timing the market, buy low and sell high? Because time the market is also very hard. It's also a zero-sum game against professional money managers. And in another video, we talked about another problem of time the market and picking stocks, which is tax. So for example, in California, you pay 54.1% for short-term capital gain tax, or up to 37.1% for long-term capital gain tax. Under this kind of tax, you need to get more than double of the before tax return in order to get the actual after-tax return. So it's already very difficult to get a 10% after-tax return. Then getting 20% is much, much harder. Now, assume you're convinced to buy and hold US broad market index. How do you buy? The easiest way is if you have regular income, use dollar cost average. So dollar cost average means you invest a fixed amount of money regularly, and you don't care about the price of the index you're buying, but you always buy a fixed amount. So basically, if the stock index goes up, you buy less shares. And if the price goes down, maybe in a bear market, you buy more shares. So that means when the stock index becomes cheaper, when the price goes down, you buy more. So you bought the index on a very good price. And by doing this for a long time, you get a very good average price. Dollar cost average is also very natural because if you get regular income from your salary, then you can invest a fixed amount of money from part of your salary. When you get the paycheck, you invest the sum into your stock portfolio. And it's very naturally a dollar cost average, and it actually has a very good long-term return. So what about another case? Assume you have a lump sum of money, one-time money, not regularly, and you want to invest. Maybe you just started investing. Maybe you got some annual bonus once a year, or maybe you have sold a house and you want to invest the proceeds into stock market. So how should you do it? It's not obvious how to invest money. Should you invest everything in just one day? Or should you split it into an equal share and still use dollar cost average, invest them periodically? If we do that, what's the value of N? How long do we need to take to invest all the money? So for this method, let's use S&P 500 daily price data from 1928 to 2024, almost 100 years of data. And the dividend is also considered. So assume we invest once a month, and we invest all the money in 3, 6, 12, 24, and 36 months, and see how it goes. So we want to test all the 30-year periods. So you could start with day one of this period, invest all the money in 3 months, and see the total return after 30 years. Or you start from day 2, invest for 3 months, and check the total return in 30 years. So basically, it's using 30-year rolling periods. So somebody did this script for me some time ago, and it's open sourced on GitHub. To run this program, you just use Python to run the main program, and it will calculate all the rolling periods if you invest everything in 1 month, 3 months, 6 months, and so on. Okay, let's go back to the results. So the summary of the results is if it takes less time to invest, then you get higher return. But if you invest during a longer period of time using the dollar cost average, you have less risk, but also less return. So specifically, the backtest results is like this. So if you invest everything in one go, in 1 month, in all rolling 30-year periods, the average return you get is 9.64%, but it has a larger standard deviation, which is 5.99, and the median of the return is 9.33. But if you split it into 3 equal shares and invest in 3 months, you get a slightly lower mean, 9.62 instead of 9.64, and then a lower standard deviation, 5.96 instead of 5.99, and also a lower median, 9.31 instead of 9.33. So this is a very clear trend. The longer it takes for you to invest, the lower the mean, the standard deviation, and the median. For me, personally, I would take 3 to 6 months to invest a large amount of money so that I can be in the market and buy and hold. Okay, that's all for today. Thank you.